This is Ken. I'm Erik. We're going to talk about macro, right?
Hey, Erik. How are you?
I'm well. It's great to have you here.
Thank you for having me.
I'm going to tell you first a little bit about Ken's firm, Graham Capital. You may not know it. It's got about $19 billion in assets, $12 billion of which are in quantitative strategies, $7 billion of which are under discretionary management. It is a macro firm.
Correct.
It has, folks, been an extraordinary year for macro. Some managers, as you may know, are up 200% or more. Ken, I know SEC rules prevent you from talking about Graham's returns, but they don't prevent me from talking about Graham's returns. And as I understand it, your funds are up between 20 and 50% roughly. And on the upper end, again, as many of you may know, that's better than Bridgewater, and it's better than Citadel. You've been in the investing business for 40 years.
Yes.
How does the macro environment today compare with everything else you've seen? And I know and am familiar with a few of those episodes. At least going back to the 90s, we're talking about the peso crisis, we're talking about the Asian currency crisis, we're talking about the Russian debt default, we're talking about the dot-com crash, we're talking about the great financial crisis, the European sovereign debt crisis, the pandemic, the list goes on. How does it compare?
Well, what I would say first and foremost is markets are moving, right? If you look at what drives macro performance and opportunities, it's how much central bank movement there is, really. Central bank movement is going to equate to FX volatility. It's very often going to equate to equity volatility. And so what's happening today that's really interesting is central banks are moving rates, and they're moving them a lot. And that's in stark contrast to what was happening in the previous decade, where it was very, very quiet. And so from a very big picture point of view, and here's kind of an interesting number. If you look at the period from, say, 2010 to 2021, and you look at the ECB, and you look at the Bank of England, and you look at the Fed, in that 11-year period, there were a total of 13 25 basis point equivalent hikes.
Among all three
major central banks. This year, there have been 26 hikes alone, and we're pricing in 44 hikes of 25 basis points this year between those three banks. So the opportunity set is obviously exponentially more interesting.
And it is just as simple as that. It is a richer, more fertile environment because central banks are raising rates.
Well, and then there's divergence, right? I mean, for example, Japan's not raising rates. They're holding their upper band at 25 basis points. We're not sure that's going to last forever, right? The dollar yen's at 146 or something today. You know, if they were to release that band, there'd be a lot of opportunity on the downside in dollar yen, whereas so far this year it's been pretty good to us being long dollar yen. But you have a very divergent set of circumstances in Europe compared to the US, compared to Japan, and so on. And so that's just good for macro trading.
So going back to your first days on Wall Street at Shearson.
Yep, Shearson. And
then you went to Dean Witter. Is this the best macro environment you've ever seen?
Well, it's up there. I mean, it was really, really good in the 80s and 90s, because if you think about it, markets were less efficient then. And so when markets are inefficient, there's a lot more to do. And there tend to be overshoots and different, market momentum events and all of this kind of thing. And as the markets got so efficient in the previous decade, and you had inflation essentially close to zero, right? There's not as much to work with. But I think, it's going to get interesting. It's going to be interesting for macro for a few years.
A few years?
Correct.
So that may be of interest to some people, perhaps even people here, because macro became an unpopular strategy. It wasn't doing particularly well on the whole in that sort of post-GFC decade. And people allocated to different strategies that were generating better returns, and they may have missed out on the numbers that I was talking about just a few minutes ago.
Yeah, the way I think about it, and I think about the history of the hedge fund industry, and most of the early hedge funds were macro funds. Not all of them, but many of them were. And people looked to us to provide a source of returns or source of alpha that was completely uncorrelated to the other things they had in their portfolio. And, I would say our investors had the luxury in the previous decade of being very heavily weighted towards beta, and you got rewarded for that. It was as benign an environment for beta as you could possibly want, with inflation close to zero and central bank policy on hold. Now the opposite is true. And so I think if macro wasn't so interesting in the previous decade, it's also important to note that we generally generated positive returns, so it didn't cost you money to be more diversified. And when you need that diversity in a year like this, we're providing it, and we didn't cost our clients money to be allocated to us historically. So, yeah, there's a lot more to do in macro now, but there's been a lot of periods in the last 20 years that have been pretty exciting for macro.
You were, Ken, months ahead of the market anyway in concluding that inflation was going to be sticky and require more monetary tightening than most investors at the time anticipated. Is inflation still the dominant theme in the macro narrative?
It's right up there. I mean, I think we've heard from Powell how concerned they are about inflation. And, rightfully so. If you go back to the Volcker era, it was really, really tricky to get rid of inflation. It took a very, very long time. It did not happen in 2 years. And if I recall correctly, the central bank started easing because they thought they had it under control, and then they had to raise rates again. I think, peaking at extraordinary high levels by today's standards. So I think inflation and some of the factors that cause inflation are not so easy for the Fed to manage. Some of them are out of their purview. The supply chain disruption, the Fed really can't manage that, right? And so the Fed really can't manage what energy prices are. So I think the Fed has got their hands full, and I think the market's expecting the Fed to be able to start easing at the end of 2023. I'm skeptical.
You are.
I am. I think inflation will come down for sure next year, but I don't think we're getting anywhere close to target of 2%. I think it may be 2025 before we get to target, if then.
As I'm sure you know, the great debate at this very moment is about overshooting. Does Jay Powell's Fed hike too much too fast and wreck the economy in the process because it has to regain the credibility that it lost, calling inflation transitory? And we might describe that as the Jeremy Siegel camp, because he seems to have become the most exercised about it. And for those who don't know, he's the Wharton professor of great repute. On the other side of the debate, which we could call the Larry Summers camp, right, is that the Fed must re-anchor inflation expectations at all cost. Which camp are you in?
The latter. The latter. I just think that inflation's so poisonous if it's not managed successfully. So I think we want to err on the side of getting it comfortably down to target. It's going to be painful for the economy. Powell's conceded that. I think that's another way of saying we're going to have a recession. When is kind of the key question, and for how long. But I think it's one of those things that we just have to accept after years and years and years of easy monetary policy. Ultimately, the inflation genie got out of the bag. It's hard to put it back in. It's kind of like an ocean liner. It takes a while for it to turn around.
So much of what you do is analyzing the economy and trying to anticipate what data will be. But the other half, at the very least, of what you do, and maybe it's more than half, is trying to figure out how central banks will respond to the data as they come out. And that, to me anyway, goes back to what you were saying about divergences. Where do you see divergences opening up and widening, perhaps, between the major central banks of this world?
Right now, the most stark example is Japan versus, say, the U.S., right? And, Kuroda's term is up, I think, in April of 23. So that's going to be an important catalyst to watch. Do they loosen that band if dollar yen goes to 160 or something from 146? Does that provoke a reaction function? They intervened in the currency markets very recently, so it tells us they're not happy with that. You've got inflation in the Netherlands. I believe it's 15%. You've got the cost of power in Europe, depending on what forward contracts you look up, hundreds of percent higher than the previous year. So they have a very dramatic inflation problem that's very supply side driven over there. The inflation problem in the United States is partially supply side driven, but partially driven by higher labor. And, you think about so many employees in the United States. I have 180 at my firm. I have some number that are 35 and younger. They've never experienced a recession. And so it's going to take a while for the psychology of the employee to say, you know what, if I'm out of work, that's not great. I really don't want to lose my job. I want to, keep working and so on and so forth. I think there is a complacency that has developed in the workforce where the expectation about constantly higher compensation and so on, and firms competing for precious few employees have been, contributing to inflation. That trend will reverse. It won't reverse quickly.
I'm curious, because you brought it up, how do you teach people who have never lived through a recession, right, who didn't have a seat, so to speak, during the great financial crisis, how to invest at a time like this? And furthermore, I'd have to imagine that besides you, there's almost nobody at Graham who was working when Paul Volcker pulled the Saturday Night Special.
Well, we do have a couple of other fairly experienced people, but look, I think that the experience of going through a recession is something that you can't teach, a person. You have to sort of go through it. You have to see the effect on your peers and what have you. Maybe it's a little bit generational. I don't know. But the bigger point is that I think we're going to come out of this fine and better off for it. It's just a reality check of having a straight shot up in equity prices for 12 years. And now we're getting a more normal market where, they go up, they go down, and we may be in a trading range for equities for some number of years. And that, that's not so abnormal.
Just as a matter of principle, I think people might be interested to know, do you believe, let's just take your investor's hat off for a moment, do you believe in price stability? Do you think the inflation target should be 2%, or do you think it should maybe run hotter for a while?
Well, I think it will be hotter for a while. I think I don't disagree with the goal of having 2% inflation. We saw how good that was for the economy, that we saw that good was for asset prices and risk assets for a very long time. So I think that's a very worthy goal. I just think it's not realistic to expect that to always be the case.
Given the picture you've painted, Ken, what do you figure the peak yield on the 10-year Treasury is going to be?
Well, that's a very good question. So the market right now for the 2-year is sort of pricing in 4.3 now, 4.75 at year end. And then I think we start to see that ease back down in the middle of 23 to maybe 4.25, something like that. And 10-year notes right now are 3.95. Mm-hmm. And
they haven't yet crossed 4.
And they have not, well, they haven't stayed above 4,
That's
right?
Yes.
And so I think there's a mispricing there personally. I don't, for all of the years I've been in finance, most of them, there was something called duration risk for being in longer dated bonds. And that's completely missing at the moment. And if you think inflation's going to be around for not just this year, but maybe 3 or 4 or 5 years, and, then bonds look a lot less attractive when you have to get out 10 and 15 and 20 year maturities. So I think there's the yield curve, which is slightly inverted, mm-hmm. will probably at some point
re-steepen.
It should get steeper.
And mispriced means a 3.95 10-year should be what instead?
50, 100 basis points higher?
Really? That's meaningfully higher.
Yeah. Well, I mean, think where we've come, right? I mean, rates have moved a lot, but they needed to, and I think they'll keep moving. So, Yeah, I think there's plenty of opportunity there.
Your firm trades Forex, cash bonds, interest rate futures and swaps, equity indices, some single names, credit, commodities, anything else?
Mortgages, but I would say the majority of what we do is in very liquid markets because we like the idea if, as a risk committee, which we meet every day and we talked about that, we want to be able to exit positions without a great deal of expense. And that's of paramount, importance to me, having been through some challenging market environments in my time. I want to always be the guy who gets out of the market sooner than later, not later, at great expense.
Which of your trades is working best right now?
Well, this year, if I put it that way, it's been a great year to trade foreign exchange. There's been a huge move in dollar-euro. Dollar-euro was 120. Now it's, 97 or something.
Dollar-pound.
Sterling has been a really good opportunity for us. Dollar-yen's moved a lot higher this year. We've done reasonably well in energy. It's been of the commodity sector, that's been the most profitable for us, which would make sense. And in fixed income, we've done quite well, being short bonds of various durations and various different geographies.
The dollar has been a profitable trade. It's a crowded trade, too. Do you think it has more room to run?
Yeah, it's definitely expensive. And I think the path of least resistance is the dollar goes a little higher. But we're pretty cautious here. We're pretty light compared to where we might have been. I think it's important to emphasize that Graham, particularly on the discretionary side of our business, is very tactical. We can be long a market today and within a few days have the other side. So we're perfectly willing to stay open-minded and move according to the changing, price data, information, and so on. And we try not to be too stubborn about that. Our quantitative systems are somewhat longer term in nature. They would tend to move around, say, over a period of weeks and months, whereas our discretionary traders, they move very quickly.
There are a lot of people interested in the British pound. You mentioned sterling having been good for you. I think it bottomed a couple of weeks ago at 103.50
right,
or thereabouts. Is that a floor, do you think, or could it weaken further?
Again, I think it's already made a big move, so I don't know how much weaker it really gets. I would be kind of neutral at these levels personally.
You talked about energy being sort of the best part of your commodity strategy at the moment.
Well, most profitable this year, not necessarily the best part of the strategy, but yeah.
Mm-hmm. Fair. Where does green energy fit into the macro analysis?
So here's an interesting point about that. One of the reasons I'm concerned about inflation being around for a longer period than people expect is our energy policies are green. And with climate change and things like that, maybe they really need to be. However, that comes at a cost of not having a lot of energy to use today. And with Saudi Arabia essentially sort of flipping us off a week or two ago, right? Energy's back, not at the highs, but it's back up in the 90s or something for crude oil. So that's pretty inflationary, and we don't have a lot of alternative sources of energy to use today. And Europe is in particularly the same situation, and that's why headline inflation in Europe is so high.
A couple of other questions while we have a few seconds left. Some macro managers, friend of yours, Paul Tudor Jones among them, have embraced Bitcoin.
Right.
Have you?
Well, we have, our traders can trade it, our trading systems can trade it. Our positions there are very, very, very small. I have to say, I don't feel qualified. I heard a speaker earlier today seemed to really know every bit there is to know about crypto and the infrastructure that goes with it. It's not my area of expertise. So I do recognize that there's going to be a pretty good opportunity set there, but it's not our area of expertise, and we try and stay away from things that we really don't have an edge in.
For my entire career as a journalist covering finance and financial markets, and even going back to before then, when I was in high school and maybe even elementary school, I remember people talking about gold as the ultimate inflation hedge. What the heck happened to gold?
been a dog. You know, it's, you know, if there was ever a year people wanted gold to perform and to, you know, be an inflation hedge, it's down, I don't know, 10 or 15% or something. And so it's been pretty unimpressive. And I don't know if I can really answer the question of why, but I can tell you our quantitative models have tended to be shorted and done okay, not dramatically generating returns there, but a little bit of profits on the short side of it. And it just has been ineffective as a hedge.
Here's where we're going to finish up, and I asked you this question backstage, so I know what the answer is, but I'm always curious about how founders decide to name their firms. And I asked Ken, Graham Capital, where did that come from? And the answer is?
Well, I started Graham in 1994, and I did so with some help from my friends at Tudor, Paul Tudor Jones, and his middle name is obviously Tudor. Another old colleague is Louis Moore Bacon. I just sort of thought to myself, third time's the charm. My middle name's Graham. It's kind of this English thing. I'll go with it.